Good evening. Today, October 6, 2025, oil prices jumped, and that affects us all. Gasoline, heating, groceries, nearly everything is tied to crude oil. When oil prices move, so does the cost of living. This morning, Brent crude rose to $65.42 a barrel, while US WTI hit $61.72. These seemingly small increases mean millions of dollars and signal a shift in global markets. The reason? OPEC+, a coalition led by Saudi Arabia and Russia, made a decision that sent shockwaves through the industry. OPEC+ controls a huge share of the world's oil, and their production quotas can make or break prices. If they cut supply, prices rise. If they boost output, prices can fall. Their latest meeting, on October 5th, surprised experts and triggered today's price spike. The world watches OPEC+ because their choices hit our wallets directly. Oil isn't just a commodity, it's a barometer for the global economy. Let's break down what happened and why it matters. At their latest meeting, OPEC+ announced a modest increase, just 137,000 barrels per day for November. That's tiny compared to the world's daily demand of nearly 100 million barrels. Markets expected a much bigger boost to keep prices in check. Instead, the small increase signaled caution, making traders worry about future shortages. Oil prices work on simple supply and demand. Less supply, higher prices. OPEC+ is trying to avoid both a price spike and a market crash. Their move shows they're worried about oversupply later this year, but don't want to risk prices falling too far. It's a delicate balance, enough oil to keep economies running, but not so much that prices collapse. Billions of dollars ride on these decisions. Behind the scenes, Russia and Saudi Arabia clashed. Russia pushed for the small increase, wanting higher prices to support its budget. Saudi Arabia favored a bigger boost to maintain market share and keep customers happy. Russia's priority: short-term revenue. Saudi Arabia's long-term: stability. If prices stay high, the world may accelerate the shift to alternative energy, something Saudi Arabia wants to avoid. In the end, Russia's cautious approach won out. The result? A compromise that keeps prices elevated, but not out of control. OPEC+ is always a tug-of-war between national interests and global market realities. Despite OPEC+'s move, prices aren't soaring unchecked. There's still plenty of oil on the market. Venezuela is exporting more. Kurdish oil is flowing, and unsold Middle Eastern cargoes are available. Analysts warn of a possible glut in late 2025 and early 2026. U.S. inventories are up, and refineries are slowing down, signaling weaker demand. Seasonal refinery maintenance means less crude is being bought. Russian oil keeps flowing, with India and others still buying despite global tensions. Even attacks on Russian infrastructure haven't stopped supply. In fact, more crude is hitting the open market. All these factors help cap prices, preventing a runaway rally. The market is a balancing act between supply gluts and demand dips. For now, that's keeping oil from breaking out to new highs. So, what's next for oil prices? OPEC+'s cautious approach sets a price floor, but if demand surges, especially from the US or China, prices could climb higher. If the global economy slows, prices could fall. Central bank moves, inflation, and jobs data will all play a role. Saudi Arabia is holding its prices steady for now, signaling a desire for stability, not a price war. For consumers, that means watching gas and energy bills. For businesses, it's about managing costs. For governments, it's a key factor in inflation and policy. Oil prices are shaped by a complex mix of politics, economics, and global events. One thing's certain: the world will keep watching OPEC+ for the next move.